Hello guys, welcome back to Profit Quest. My name is Adesh Kanappan, and today we're going to be starting Unit 4, Risk and Insurance. So, what is insurance? Or why is insurance important? Insurance or insurance companies provide coverage financially for repairs that can occur from catastrophic events. So some examples of catastrophic events could be a car crash or your house burning down. And these insurance companies would ensure that they pay back maybe not all, but a part, and usually a large part, of that money to ensure that the catastrophic event doesn't affect your life 100% of the future, for 100% of the future. So the insurance companies are there to make sure that when you pay them, they will also financially support you if something goes really, really wrong. And these insurance companies are extremely important. These insurance companies can help us maybe 100% bounce back from things that might have destroyed all of our belongings, all of our important items or important financial assets. Insurance companies can provide for great bounce back ability, which I know isn't a real word. So insurance companies cover for risk. And if you want to understand the full function of insurance, we should understand what risk is. So risk is the measure of a catastrophic event and the measure of how that catastrophic event may or may not occur. So, for example, if you have a vehicle accident, and let's say you are a reckless driver with many cases in the past, your risk for a vehicle accident would be much higher than a normal driver that is not as rash as you. As a result, insurance companies would calculate this before allowing you to apply and pay for the insurance that they provide. It could also be a medical emergency. So the risk that a medical emergency may happen, the risk that an attack upon your professional liability may happen. So essentially the money that may get extorted out of you, and the risk of theft happening. So if someone were to steal your items or your money, that is also a factor that insurance companies factor into risk. So at the basis, insurance companies, as I said, are businesses that provide financial protection through policies. So these policies are policies that pay back the financial harm done to you by these catastrophic events such as car crash or medical emergencies. And today we're going to end off on how insurance companies work. So this is just like a general overview of how a insurance company really works. First, before you actually get the insurance from them, they determine the likelihood and financial impacts of the risk. So let's say you're at a high risk for a house fire for some reason, and the insurance company that you're asking for insurance is very small. They might factor in this high risk for, the burning down of a house for some reason. And they might not agree to give you insurance based upon your risk because they're small and they don't really want to pay back an entire house or a percent of a house. Next, the insurance companies calculate the price that actually you should pay to them for attaining their insurance. So this customized pricing can be based on various factors, such as one's occupation. If you have a higher level occupation, you might be better, or you might have a higher interest or a higher insurance price. Your driving record. So if you have a worse driving record, a company might make you pay more as you are at higher risk to have a car crash. Your health status. So if you are not very healthy, insurance companies might make you pay a little bit more, which might seem a bit nefarious, but they might make you pay a little bit more as they're at a higher risk of paying for your medical emergencies. And finally, your age. And step 3, they spread your risk across they spread your risk by taking in some of the risk and ensuring stability and financial security if that risk happens. So let's say your insurance company has promised to pay back 70% of your house in case, that small risk did happen, your house burns down. 70% of the losses sustained by the burning down of your house would be insured by the insurance company, stretching out your risk and making it so that your risk is less, but coming at a cost because obviously you have to pay the insurance company for this insurance. So thank you. This is all we're going to talk about today in Module 1. I hope you have a good day, and I'll see you in Module 2.